Assalamu alaikum, second year commerce. In the last class, in the last revision class, we started the revision of chapter number 4, Central Bank, and the topic was Principles of Note Issue. In the last class, we discussed that there are two principles, one is currency principle and banking principle. And we discussed that currency principle, but according to this principle, that the note that government is printing note, every note is backed by 100% gold reserve, which makes this principle a rigid, safe. Look, these are the merits and demerits of currency principle. This system is inelastic, which we can say rigid. It is dependent on gold. We cannot print more notes. If a country doesn't having gold reserves, they cannot print more notes. Unnecessary lockup of gold and rejected by real world. Same time, there are merits that this is a very safe and secure system. No danger of inflation in the country, and public feel more confident when such principle is adopted by any country. So now what we are going to today we are going to talk about the second principle, and that is a banking principle. As I told you that banking principle is inverse, or you can say it is a contradictory. It is totally different from the currency principle. What this banking principle is saying, this banking principle is saying no need to keep 100% gold or silver against notes issued. The note issued in the country should be according to the needs of trade and industry. Now, what does it mean, guys? Look, this is the trade and industry, and notes issued according to the need of trade and industry. So, this principle, I will explain you this thing by this example. Now, look this word file. Look, trade and industry. For example, we know that whenever country do exports, country receives the payment in, and whenever country do the imports, they have to make the payment outside the country. Let's assume one example, an ideal example, when country exactly does the exports 200 USD dollars, and exactly they make the import that is equivalent to USD 200. So it means that country has to receive 200 and country has to pay USD dollars 200. It means zero. So result will be zero. No need to print extra notes. No need to print extra notes. Exactly what is here, that country has to print only the notes which is needed by trade and industry. According to this example, now look at the example number 2. Payments in the country in means country is doing exports, that is $200, and country is making imports and they have to make the payment. How much payment they have to make? $400. So it means 200. The extra they have to pay dollars 200. So now they need to print notes, extra notes, okay? Extra money notes. Money notes of rupees 200. Okay? $200. So this is the simplest way that I can explain you, that every bank will print their own notes according to the need and demand of industry and trade. Now look, now come to the definition of this banking principle. Yes, banking principle. According to this principle, Mr. Took, I got this image of Mr. Took from the internet. I hope it's a correct picture. So who was he? He was the supporter of this principle. So what he is saying, there is no need to have the reserve of gold and silver for the issuance of notes. So banks are authorized to regulate the notes issue, keeping in view the needs of trade and industry. It means every bank should calculate their in and out, what they are going to receive and what they are going to pay. According to their need and in and out, they maintain, they regulate the note issue. I hope this is clear. If not, you can ask me. You can ask me in comments. I will explain you more. So the bank themselves maintain adequate reserves. They are maintaining their own reserves. Every bank knows that how much the bank needs to pay and how much bank is receiving. So they are going to maintain their own reserves, their own notes. Okay. So if there is an over issue, if bank is going to over issue, they know that if we are going to over issue the notes, so we have to do more exports, we have to more do the exports. So they will maintain their own ratio according to their need. Now guys, come to this slide. Now we will talk about the banking principle merits and demerits. So one of the merit, elastic. Yes, this system is elastic. It is not a rigid system. Why? Because whenever government needs or any bank needs the note, they can print and they can adjust later in future. So government, at the time of government needs, government can print. This is a very popular principle of note issue throughout the world. And surety, what is the surety? Surety is that bank knows that if we will overissue it, we have to maintain, we have to control within the limits of each bank. So now discuss these merits and demerit one by one. So elastic system, the banking, this principle is elastic because gold is not kept for current percentage value of note issued. You can write in your own words according to your understanding. So government needs, this system is fit for meeting the government needs in case of emergencies. If government needs money, government need notes to make the payment for huge projects, they can print. This is not a rigid system. And this system is popular all over the world. Every country is issuing money under this system. I told you, remember that currency principle is not adopted by any country. So all the countries right now in the world, they all are using this banking principle. So it also provides surety for the convertibility of notes. Yes, there is a surety. If any bank is overissuing it, then the overissued amount should be backed by asset. Okay, so overissued amount should be backed by an asset. It could be a gold, silver, and foreign exchange. Now look guys, the demerits of banking principle, overissue. In order to meet the demand for money, there may be further issue, no issue of notes beyond the certain limit, which leads to inflation. Guys, this could happen. It is a possibility that if any bank is not maintaining the ratio, if bank is issuing the notes beyond their demand, and then it could lead to inflation. Economic crisis, during economic crisis, yes, there is no full convertibility available. Maybe bank refuse for convertibility means if you give the money to government, government will give you in against the gold, the reserve. In the economic crisis, for example, if war in the country, okay, maybe government refuse to convert the currency with the asset. So this is the last demerit is balance of payment. This is not good for keeping the stable exchange rates. Whenever there is a change in foreign exchange rates, the balance of payment positions become more unfavorable. Guys, here we are ending. So what does the last line mean? last line, I to explain you the last line, come back here in this example number 2. So right now it minus 200 shows more payments are going out from the country and more less payments are coming in the country. So this is unfavorable balance of payment. This could be possible when banks are doing this thing without keeping reserve. If I'm a bank, if I'm doing this, okay, this like I'm receiving less payment and I am giving more payments out from outside the country, I need to keep these 200 reserves with me. Okay, so guys, these are the two principles. I hope you understand. Please do revise. Any problem you can ask me. Take care.